All right, let's work it real quickly. This first one should be a gimme question. So the mean is 0. The standard deviation is 0.012. Remember, convert everything into decimals. The risk tolerance is 0.008 or 0.002. So the table value, you might just automatically do that as 1 minus 0.002 or 0.998. And the budget portfolio is 1.3 billion. And the budget is 45 million. So the table value at 0.998 is 2.88. Everybody agree with that? Is that what y'all got? 2.88. There's that 0.998 right here. And that equates to 2.88. And so the value at risk equals 0 minus 2.88 times 0.012. That's 0 minus 2.88 times 0.012, excuse me. 3.456. That times 1,300 is so that's 0.03456. Remember, you do it in absolute terms. You don't have to put the negative sign there. And so the var in dollars going to equal 1,300 times 0.03456, and it's going to equal 44.928. So over the budget. So taking too much risk. I'm not real picky on that. I just wanted you to say they're over the budget. It's too risky. Not. Oh wait, are they over the budget? No, they're within budget. Excuse me, just barely. I was thinking 48, but it's 45.8928. Acceptable. I don't know how to spell acceptable. It is Bill Gates. All right, so it should be a really easy question. It's one of those that the minutes you have is much less than you need, so it's one you can quickly do. All right. And then on this one, let's just get the lines down. So the highest line is always what? Cost of equity. The lowest line is always what? Yeah. Oops. And then the middle line is always the x-axis. The x, that's the allocation to debt, percentage in debt. So 0% debt all the way up to 100% debt. And then line 5, that's also the WACC, or it's just the cost of capital really, because it's the equity, the debt, and the WACC. All right. So I don't know on the essay, we'll see how y'all did. Team 6 looked like it had something written pretty well down, but so can you increase the value of the firm by changing? I mean, it's really straightforward, isn't it? All they're asking is, can you change the value of the firm by changing the allocation to debt? As you go from 0 debt to 100% debt, does the value of the firm change? And before taxes, doesn't make a difference. Why? Because as you increase debt, which has a lower cost, your cost of equity goes up because more debt increases your beta. So it has no impact. After taxes, increasing debt reduces your cost of capital because of the tax shield of debt. However, at some point you take on so much debt that bankruptcy costs take over. So yes, there is an optimal level of capital. It's where you balance that tax shield with the bankruptcy costs such that your WACC is minimized and the value of the firm is maximized, something along those lines. All right, you need each one of those pieces I just said. I'm not going to type it again because you already have 3 versions of this as it is. You don't need a 4th one. I think the real key is read it and then type it in your own words and then memorize what you have in your own words, or at least memorize an outline of them. It's a pretty critical part of finance. All right, we'll see which team won. Which team thinks they won? 3 thinks. All right, we'll see. It's gonna be close. Okay, just a few last things to hit that are topics. Most of the ones are missing. You'll see in other classes. Value at risk. I did give you a few extra examples of value at risk if you want to look at them. They're a little different than ones we did because the mean is not 0. So if you're looking at annual numbers, like on the stock market, you might say the stock market has an expected return of 8%, 2.33 is a 1% risk tolerance, and then the stock standard deviation is 15%. This is not that uncommon. I give y'all some different examples. You should be very, very good at this. You should have done this in your stats class. If you're accounting or finance or marketing, you should be really, really good at this because they do this all the time. And so handling that normal curve, hopefully, did they just overwhelm you with it in your stats class? They should have done it over and over and over again. So you should be absolutely, without even thinking about it, able to use that normal curve. Extremely critical part of what we do in finance and business all the time. We're not going to cover this. I do this in my risk management class. What do you do when you're dealing with correlation? You got several things. So this is a really famous formula. If you're a finance major, you should know this formula. If you're not a finance major, maybe not. But if you take my risk class, we get into that quite a bit. They handle that. They actually do it on the final exam. All right, we talked a little bit about this. What we're doing is parametric value at risk. Parametric means you're using a normal curve, that risk tolerance in the normal table. Historical VAR just means you're running simulations, but you're letting history define the simulations. So how much would we lose on a day if the 1970s repeated? And you walk that through, and oil prices shoot up and that kind of thing. How much would we lose? What's our worst case in the 80s and the 90s? Stochastic is real similar to historical, except for you create your own simulations. So it's just simulations. So I showed you how to do simulations using Excel, just a random number. You can do it. We did a lot of stochastic at UTSA. It's really quite powerful. I got a stochastic model, and right after I got it, AIG came in to sell us something. And they were thinking a bunch of hillbillies in Texas. They said, you'll never figure this out. And I got it assigned to me, but they didn't know I just got the stochastic model. I set it up. I went back to them and said, you're charging us 10 times too much. And he looked at me like, how did you figure that out? And said, yeah, you've charged. And he was like, you're the only ones that figured this out. But we had a model. If I had not had the model, I would not have been able to figure that out. It would have been too complicated. So that's one of the advantages of stochastic, is you can set up a really complicated problem and then you can let the computer do all the work just by running a bunch of simulations. So it's a really cool thing. Hopefully some of y'all will get this. Now, if you want to do simulation and you want to get something on your resume, so let's say you're finance or marketing. We have some marketing majors in here, right? So marketing. So where would you go? At risk is a good one. I forget who owns At Risk. So at risk simulation, they probably have a student model that you could probably buy for $50 a year or something. Oh, that's right. Palisade, you don't forget what it is. They have a try for free. I got a buy now. Buy now is who knows, 1 year. Oh, it's a little steep. $3,200. Now, I don't know what anybody know what UTSA has. It's between At Risk and the other one is Crystal Ball. Crystal Ball is the other one. It's owned by Oracle. So I don't know. Does UTSA offer either one of those to y'all? Do they? Who's saying yeah? No? All right. So, now USA, we built our own. So we had one, and then the actuaries use AIR and RMS. So if UTSA had this, I would really recommend that you go out and experiment with it. Use it in one of your classes. If not, go out to YouTube and watch some videos how to use Excel random number generator to create one of these simulation models. You can do some really powerful stuff with the random number, because that's really what simulation is. It's just creating random numbers. Now, the advantage of crystal ball and at risk is that you can have multiple things that are correlated with each other. That's really hard to do with random number generators. But so if you want to say, hey, I want to run a stock market and a bond market, and they're correlated 0.2 or something, then that'll make sure you get a distribution that makes sense with that. But powerful stuff. And that is what stochastic is. Not many undergraduate students do that, so it'd be powerful. Are any of y'all going to take the modeling class? Do you plan to? Finance majors probably. So I don't know, in that class they may do some simulation models. If they don't, I would ask the professor, say, well, maybe they'll do some stochastic modeling in this class, and maybe they'll add that to the class, because I'm pretty sure whoever's doing that class knows how to do that. So, ask them. You might also email the librarian, Natasha, and say and just ask her, does UTSA provide us access to at-risk or crystal ball? Natasha's wonderful. She's my favorite librarian. You can tell her that. But she'll tell you, yes, we do have it, or no, we don't. We can't afford it, or no, we don't. But since you're asking, if you get enough students to ask, maybe we can add, those all the kind of answers she'll get. She'll know off the top of her head. All right. Other risk we haven't covered, credit risk. Credit risk is just that someone defaults on you. The main way we measure that is just like you did on project one. You look at credit ratings. Credit ratings are a really good source. So let's say you're a marketing major and you want to do a software package with Oracle, and your boss says, Oracle, can we trust them? You can go out, what is Oracle rated? Usually you can just Google that. Oracle ratings, credit ratings, and they're usually out there. They're BBB, so they're investment grade. And your boss says, yeah, but can you do a full-blown financial analysis? You could have two responses. One is you do what you did for project one. Or two is, boss, there's no way I'm going to be able to do as much work as what S&P did. And S&P says they're BBB. So do you want me to spend 40 hours, 50 hours doing something that S&P just spent 1,000 hours doing with people with high degrees? Or you kind of talk them into credit ratings is enough, because it really is. BBB is a very reliable. Their investment grade is not great, but they're not horrible. They're kind of medium. Yeah, they'll probably still be in business 5-10 years from now. So that's a good way to do it. Do you want to do a contract with Bed Bath and Beyond? A CCC company? No. They're CCC rated. They're not. There's a 50% chance they'll be out of business here pretty soon, and there's almost 100% chance. And how do we mitigate it? It really is just making sure you don't have too much exposure to low quality companies. Right now, we're seeing that in the banking area. Everybody's worried about what banks you have business with. With JP Morgan, you're probably okay. If you're with Western Pacific, yeah, maybe you panic and you take all your money out. Who? I don't know about their credit quality. I don't know. They're not really a bank though, right? So I'm not sure the credit is there. I did this at USAA with Bob Davis, and he came in and he said, we have too much exposure. And so I'd say, well, what about 2%? No, that's too much. Go back. I said, what about 1%? That's too much. I finally said, you just got to tell me a number. He gave me a really low number, and it was pretty interesting because our largest exposure when he did that was a company you might have heard of. I don't know. Have I told y'all this story before? Our largest exposure was Enron. And he said, and he cut the limits, and the bond investors, they called me, go, Ron, that's crazy. We usually buy 50 bonds. We're going to have to buy 500 bonds now. I said, yeah, that's the rules. So By the time Enron went under, we had almost no exposure. We went from them being our biggest exposure to being a tiny exposure. And they called me and go, you know, maybe he knows what he's doing. He got us out of this huge risk. So, you know, that's the way you do it. Just make sure you don't have too much exposure to any one entity. So if they do go under, you're okay. Operational risk is just everything else. Policies, procedures, your hiring processes, whatever. Something just goes wrong. There's all kinds of examples of that. Very hard to measure. We just don't really know what they are. SAS came in to our company and said, we'll help you measure operational risk. And I said, okay, great. That we went to the meeting. They said, give us your mean, correlation, and standard deviation, and we'll help you. And I said, that's the three things I don't know for operational risk. So it was, you know, one thing that really helps, and I do this on my bike, is take close calls really seriously. Airlines are really good at this. Airlines, they don't just study when a plane crashes. They study when a plane almost crashed. And they do a detailed study of what went wrong. Was it training? Was it the plane? Was it the manufacturer? Was it the control tower? Was it fatigues? They've had a few places where it was just the pilots were too tired, and that changed the rules. They're really good at that. On my bike, anytime I crash on my bike, I stop and think, okay, what went wrong? I've changed my routes because some roads are too dangerous. There's certain places, I've noticed when I change surfaces, my bike tends to wipe out. So anytime I go from asphalt to concrete, I always slow down now. I used to just fly over that. But close calls, even if nothing happened, nothing went wrong. So like I have a close call on my bike where I slip and I almost crash. I'm taking note of that. So on operational risk, that's not a bad place to do that. And how do you mitigate it? You're just very, very diligent. This is what I did at USAA. I think I've talked about this before, but I sat down at USAA and asked, how can I destroy this company? We talked about that before? I get my two, no? All right, so yeah, I sat down because one person shouldn't be able to destroy USAA, right? Emmanuel, you shouldn't be able to, as an intern, you shouldn't be able to destroy USAA. Huh? Well, that's what my thing is. Could I destroy this company? When I started out, I couldn't have. But at the end, I could have made one phone call and so I'm thinking I shouldn't be able to do that. And so I went to the CFO and I said, okay, I should not be able to do these trades and you need to monitor. So we made it so every time I did a trade that went to CFO and they had to check to make sure. And then they would have to send out an email and say that they checked and everything was fine. So, and there's one time he didn't send out his email and I called Silas and say, Silas, what are you? He says, I'm too busy. He said, no. You can't have me doing trades. I could be having a really bad day and it's like, I hate this company. I'm bringing the whole thing down and I could have done a trade and it would have been horrible. So, and then I told the CFO that after the fact. I go, Joe, did you realize what power y'all gave me? I said, I want to do these transactions. Say, oh, sure, fine, do whatever you want to. And it's like, no, y'all shouldn't do that. That doesn't make sense. So made him really nervous. All right. So there's other things. If you take my risk class, my favorite risk is interest rate risk. We're not going to really cover that in here, but that's a really fun one. That's where Silicon Valley went under. They did a horrible job on interest rate risk. They messed up on the most basic things. So the students taking my risk class, if they'd worked for Silicon Valley, that bank would still be in business today because they would have seen the obvious that Silicon Valley wasn't doing correctly. I love risk management. All of y'all need to think like risk managers. This isn't just a finance thing. Think about what your firm's doing. You've seen these firms go under. You don't want to be working for one of those firms. Asking those kind of questions, learning the firm. I would work risk management into an interview. When they come back and say, what questions do you have? Says, man, I want to work for a great company. I want a company that is constantly looking for being innovative. I want a firm that's really good at risk management, where if you see something that's not right, people want you, and then ask the person interviewing, is this the type of companies like that? How do you think about this company in those terms? And boy, you might get the lie where they tell you the good story, or you might have an employee that's just kind of ready to get something off their shoulders and you get the truth splattered all over you. Who knows? But that kind of, I want a culture of innovation and risk management and see what they say. Could be a great, mean, you get two things out of that. You get them thinking you're the kind of employee they want, but you also might get the naked truth from them. We're not going to cover working capital. We talked about it earlier though on paper 1 is how do you collect your receivables faster? How do you make sure your inventories aren't sitting there becoming obsolete? So you'll get this in your management classes. So we have a few management majors in here, right? I don't know what industry you've picked to work in, but if you do retail, inventory management is going to be a huge part of your job, isn't it? Personnel management is going to be a huge part of your job, but you don't want inventory sitting there. If you're doing management in HEB, you don't want the bananas going bad. You don't want the milk going bad. I remember one HEB, I bought milk and got home and it was spoiled. So I go back a few days later, and that same expiration is still sitting there. And so I caught one of the guys and I go, yeah, I bought this milk last week and it's still a week later, still here. And they all go, oh no, someone's not doing their job. Yeah, you got to check on that. So yeah, these are kind of things where management side really gets involved. I don't know if all of y'all take a management science class. Is that required? Management? You have to take one management. Did y'all do reorder points and all those kind of things that you said? So that's really not a finance topic, but finance majors should know this. Cash management we're not going to cover here, but treasury management is a career. If you're accounting or finance, treasury management is a career. I worked in it. It was like a 25% of my job at one point. So I worked in it. I wouldn't want to do it, but there are people who enjoy it. What treasury management is it's kind of like being a police officer. So most of the time it's kind of boring and redundant, and every once in a while it's incredible high stress. That's what treasury management is. So most days you're just managing cash, and then a day comes up where you need 40 million bucks and you don't know where you're going to get it from. Let's see, we're not going to cover this. A lot of this stuff has changed pretty dramatically because of truncation. So it used to be a lot of checks were written. How many of y'all write checks today? Anybody still? Y'all write no checks ever, or just one a month? Maybe one a month or so, but pretty rare. Do y'all receive checks very often?
Yeah.
Do you know we used to have to drive to the bank to deposit those? And now at HEB, what do you think when the person in front of you is writing a check? You're like, wait, it takes a lot more time, doesn't it? But even now they'll actually handle that check at the register, and you even give the check back to them. So that world has changed. We used to fly millions of checks by plane every night. They don't do that anymore. It's all electronic now. United States is fairly unique in the use of checks. We use checks probably more than anybody else, even still now. Do you have grandparents that write checks all the time still? And so even they're converting. So that world is changing. So there's really not a reason to look at that. So inventory management, we won't cover that in this class, but if I were an accounting or finance major, I would want to have a class where you cover economic order quantity. Have y'all had that, accounting and finance majors? I know the management, so Gonzalez, you'll have this one, right? JJ, you'll have this one, right? EOQ.
Yeah. Oh yeah. You just have an exam with that.
Huh?
I had an exam recently and it had that question.
Yeah, so it's probably gotten more advanced than I was taught it because I haven't had it in years. Pretty critically important stuff, right? So did they still call it EOQ?
Yeah.
All right. There's probably some AI in this as well, right? Because you have a pandemic, everything changes. You have a Putin attacking Ukraine, things change. And so, yeah, and the Tokyo earthquake, they couldn't build cars because they were doing, just-in-time inventory, and suddenly they couldn't get parts from Japan and people couldn't sell cars. So yeah, it's a really important part. And then your eco class is going to talk about inflation, interest rates, and currencies. Yeah, if you're a finance major, this you got to know backwards and forwards. You've got to become a quasi-economist if you're a finance major. If you're accounting, kind of depends on your industry. One industry will interest rates be really critically important. So banking, obviously, construction, real estate, interest rates are really, really important. Insurance, interest rates are really, really important. Some of you, if you work for a Nike, currencies are really, really critical. At USAA, currencies were a really, really small part, but I had to manage USA's currency book. I hated it. I hate currencies. But our CEO got attached to it for some reason and wanted us to manage that. Inflation is probably an issue for everybody. So understand interest rates, how they move. So you should have an economics class that talks about why interest rates do what they do. Why does the yield curve, what does it do? Do what it's doing. Right now it's inverted so that short rates are higher than longer term rates, but normally it's upward sloping. So you want to make sure you have a class that covers that and read those chapters. There's some theories about it. If you're a finance major, you probably should know that you should know the theories: the unbiased expectations theory, the liquidity preference theory, the market segmentation theory. You should know those theories really, really well in finance. Most people, it's the unbiased expectation, except for there is somewhat of a liquidity preference theory where shorter term stuff is just safer and easier, and longer term stuff a little riskier. So we do demand a little bit higher return out there. And in market segmentation, it's just like there's supply and demand forces going on. And in currency management, I don't think we have any international business majors in here. So what is international business? International business is business with currencies and politics. That's all it is. And international business is, it's not like international business. They don't do finance. They do finance the same we do in the United States. Accounting's the same. You just throw in currencies. So if I were an international business major, I would become an expert on currencies. How do you become an expert on currencies? You become an expert on interest rates and inflation, because that's what currencies are. They're a reflection of interest rates and inflation. Let's see. And deficit, government deficits. How high can inflation be? You can go back and look at hyperinflation. There's inflation in Zimbabwe. When you have to use exponents to measure inflation rate, you probably have pretty high inflation. So when your inflation is 10 to the 30th power, that's how many Zimbabwe dollars you need to buy $1 US, 10 to the 30th power. You have an inflation problem. So what were they doing? They're just printing money. And then Germany had the same thing after World War I, which is part of the reason we had World War II. It was hyperinflation. So there's their inflation, not quite as bad. I don't think it's 30 zeros, but pretty hefty inflation. That was a time where you had money in a wheelbarrow and you had to run to the store, because if bread was 10,000 marks, by the time you got to the store, it's now 20,000 marks. So if you didn't run fast enough, you couldn't afford bread. So yeah, that they had a hyperinflation as well. Could US have hyperinflation? What we're seeing right now at 8%, 9%, that's not hyperinflation. But is it possible? Yeah. How would it happen? US government would just start printing money. You'd have to have the government printing money for it to happen. So do we want a strong US dollar or a weak US dollar? And the answer is yes. Yes, we do. A weak US dollar, what does that do? That makes our stuff cheaper overseas. So that's good. But it also means stuff overseas is more expensive, so it's inflationary. Strong dollar, what do you want? Makes imports cheaper, reduces our inflation, but it hurts our exporters. So which do you prefer? If you're traveling, which would you rather have, a strong dollar or a weak dollar? Strong dollar makes stuff a lot cheaper, right? But if we have a weak dollar, more people are going to come and travel and visit the United States. So if you're in tourism in the United States, you want a weak dollar because you have more tourists. There were actually people flying from the UK to New York to have dinner because the dollar was so weak at one point. Hotels were cheap. What looked like a $300 hotel in the UK was like 150 in the United States. So, you know, it helps tourism in the US. You can certainly look and see what the dollar should be, and there are ways to do that. My favorite is this one, the Big Mac Index. So you can look at the Big Mac index and it tells you if the dollar is expensive or cheap. We're not going to cover international business, so we didn't quite get through the last part of the notes, but anyway. But we covered everything on this second exam. You should just know, all right? Don't memorize any of it, just know it. That's everything on this first exam is just the basics of finance. Every business major should know, whether you're finance or not, all right? So don't memorize it, know it. 5 years from now, you should still know everything on this exam, all right? And don't forget the stuff from the first exam either. That's really important, but at least you can look it up if you need to and go back. All right, I hope I'll see some of y'all actually sign up for my class in the fall. That's kind of wild. So hopefully that's a good sign. I do want all of y'all to be successful. I'm your professor for life, so you have the right to email me anytime. 20 years from now, I'll probably be in the old folks' home and I won't remember you and I won't know what a discount rate is, but you have the right to come to me anytime. I've had students have a project in their first job and they're like, how do I tackle that? You're more than welcome to call me and I'm pretty good at even for industries I don't have an experience with. I'm pretty good at either finding data or finding someone who knows where the data is. All right. I'll see y'all on Thursday for the final